Hi there, welcome to Market Call. I'm Paul Bagnall. Thanks for joining us on today's show. Colin Stewart is our guest today. He's Chief Executive Officer and Portfolio Manager at JC Clark. He'll take your questions on North American equities. So pick up your phone and give us a call. Our number is 1-855-326-6266. You can also email us right now at marketcall@bnnbloomberg.ca. So get your questions in on North American equities before too long. Colin will be responding to your questions. Colin, welcome to the show.
Good to be here, Paul.
Let's talk about this remarkable rally that we've seen since early April. Everybody who's long the market is glad to have seen it, but you think there is volatility coming, i.e. a pullback. Is that fair to say?
Correct, yeah. I just think we've seen such an extended rally here. Valuations are high. People seem to be largely ignoring a lot of the potential risks, not only some base level of tariffs, we think, and that's obviously that rhetoric's accelerated in the last week or so. And then I do think if you look from January 1st to today, you've got more geopolitical risk. Earnings estimates have come down from the beginning of the year. Market has continued to rally in the U.S., obviously from a sharp sell-off in April. So we've got very, very high valuation multiples, particularly in U.S. stocks. We're a little more positive on Canada, but I just think investors are being complacent right now, and it's time to be, as an investor, a little bit cautious.
And you think rising stocks and rising bond yields are not compatible? Why so?
Yeah, I mean, I think, the market, the bond market is really telling us they're concerned about inflation. They're concerned about the U.S. deficit. They're concerned about these tariffs potentially being inflationary. And even today, as we've seen more tariff rhetoric, you've got, bond yields moving up. So I think that's a clear sign that the bond market has one view, and people often find the bond market as a better gauge of what's going on in a macro standpoint than the equity market. But the equity market, I think it's being driven by momentum, retail investors, a lot of hype around artificial intelligence, which is obviously, going to be important, although we don't yet know how profitable these companies are going to be from this massive CapEx investment they're making on AI. So I just think there's a lot of positive news built in, and the market is, at least at this point, things were different a couple months ago, but is really focusing on the positives and sort of just pushing all the potential negatives aside.
So if I understand correctly, you believe this is the right time to have commodities exposure. Is that correct?
Yeah, no, I mean, we don't tend to have a ton of commodities exposure particularly. We own some, a little bit of gold, a little bit of energy, but, overall our firm is not a heavy commodity investor. So, I would say it's the time for defensive businesses, good cash flow generating businesses. We think that value investing is perhaps going to have a little bit of a comeback relative to growth investing. And as I said, we're definitely believe and are favoring Canada over the U.S. right now from an equity standpoint.
Okay, that is Colin Stewart. Those are his opening thoughts. We'll be back with Colin Stewart right after this. He'll take your questions on North American equities. Here's the number one more time, 1-855-326-6266. And the email address is marketcall@bnnbloomberg.ca. Okay, welcome back to Market Call. Colin Stewart is our guest. He's ready to take your questions. Here comes a question via email from our viewer, Henry. Henry wants to know about Tesla. What's your outlook on Tesla, Colin?
Yeah, we don't own Tesla. I mean, I think it's, in many ways a remarkable company when you look at the innovation and what they've developed in a very short period of time. But, we do pay attention to valuation, unlike a lot of people. And I would put people who own Tesla stock in that category. It trades at 165 times forward earnings, which is clearly it's not being valued on the automotive business alone. People are baking in a lot of positivity around robo-taxis in particular. And, we think that's an interesting technology, but I would tell investors, well, you can just go and buy Google. You get Waymo for free. Basically, there's no implicit value on Waymo in Google's valuation today. It's not making money yet, and you're buying Google at 17 or 18 times earnings. And Waymo, in fact, is quite a bit ahead of where Tesla is as far as number of miles driven, number of autonomous cars on the road. So I think that would, if you're really looking for a way to play that robo-taxi trend, which seems to have been driving Tesla stock recently, I would say have a look at Google.
Okay. Thanks for that question, Henry. Here comes a call from our viewer, John, in London. John, thank you very much for your call.
Thanks, Paul. Hello, Colin. Colin, I bought a little stock a while back called Celestica. It's done very well. Everyone seems to like their switches, and they also have original equipment and knowledge services, so AI services. So they've expanded their revenue base and profit base. How would you contrast Celestica, which I hope you could evaluate for me, versus the Mag 6 Tesla side? Thanks very much.
Yeah, so I didn't catch the last part in contrasting Tesla, but I can happy to give you my opinion on Celestica. Sorry, I think it's a great Canadian success story. This was for a long time a contract manufacturing business for technology firms, and traded at a very low multiple, and they position themselves very well to benefit from this AI trend and all the build out of data centers and the semiconductor companies, the huge amount of money that's being put into AI, and Celestica is benefiting from that because they're participating in that in that manufacturing and build out. So, and it's not, even though the stock has had a huge run, I wouldn't classify it as a cheap stock. The multiple has gone up a lot from where it did trade, but the earnings momentum is there. We don't own it, but I wouldn't say it's egregiously overpriced. So if you've been lucky enough to own it on this run, I might take a little bit off the table, but perhaps hanging on to some is a good idea.
Okay. Thank you, John from London. Let's go to Elliot. Elliot's in Hamilton. Hi, Elliot.
Afternoon. Please, how would you evaluate the prospects for Sprott? And do you think SII might be a good backdoor way to play the commodities? Thank you.
Yeah, I do think, the Sprott's built a great franchise around, they sold their sort of fund business a number of years ago and built a great franchise around really commodities and precious metals. Was the sort of start to that engine, but since then they've diversified and have, all kinds of products that give investors exposure to different commodities. I know in particular their uranium ETFs have been a big success recently. And so it is a good way, I think, to get a broad participation in not only asset flows into commodities, a varying bucket of commodities, but also benefiting from some of the fees they're generating on their products as an asset manager. So yeah, it's fairly niche and specialized, and the stock has had a big run. But I think that speaks to the success the company's having right now.
Okay, thank you for that question. Let's go to Daniel in Markham, Ontario. Daniel, thank you for your call. What's your question to Colin?
Hi, Paul. Hi, Colin. May I have your thoughts on Lassonde Industries, the juice company? What price is a good entry point for the long term, and do you own this stock for yourself and for clients? As usual, Paul, great host, and Colin, great guests. Thank you.
Thank you, Daniel.
Thanks, Daniel. We know Lassonde. We don't own it right now, but I think it's a good business. They are primarily in the packaged food and juice business, and they have had some good success growing in the U.S. through acquisition. They have, like many other food companies, have faced some input pressure from commodity costs, and manufacturing business has during COVID faced some margin pressure, but things seem to have from what I know, things seem to have stabilized on the margin front, and the company has a strong balance sheet. It's not an overly liquid stock, but it is does even though with the run we've seen recently, it does trade at a fairly reasonable valuation multiple. So it's one that sort of is always on our radar, and the kind of stock that if it does have a pullback, we might look to take a position. Okay,
up about 30% over 5 years and has had a big rally over the past couple. Let's go to Reg in Winnipeg. Hi, Reg.
Thanks for taking my call. Colin, my question today for you is on Manulife Financial. Every once in a while I phone in on Manulife to give it some airtime. Now, when you look at the trading, daily trading on Manulife, it has very strange trading behavior. Today, open straight down. Last 15 minutes on the TSX, straight down. You look at the fundamentals on Manulife versus the banks, for example. It has a 4.5 dividend. Its forward PE is about 10. Has a major footprint in China. Assuming that China does a trade deal, which they will, Manulife has a huge presence in China that those consumers will need Manulife products. Yet the stock, since the last earnings, has gone straight down. The bank analysts that should be rating Manulife have dragged their feet on re-rating Manulife. It makes no sense. It is way cheaper when you line it up against Great-West or Sun Life. It's trading $10 below Great-West. Easily, it should be the same price. It should be over $50. It's undervalued.
Okay, Colin's view on Manulife. Thanks for the question.
Yeah, we don't own Manulife, but I do agree with some of the things you said. I mean, I think it has a very strong franchise in Asia. The life insurance business is generally benefiting from, an aging demographic and more people, particularly in more developing and emerging markets, starting to purchase life insurance for the first time, and I think they're well positioned to take advantage of that. And as you point out, it doesn't trade at a demanding PE multiple and has a nice dividend yield. But I can't really speak to, and we don't sort of watch the day-to-day or minute-to-minute trading of Manulife. And I would say there are a lot of stocks today that trade in a strange way, and I think that's because of more algorithms and quantitative investors that are trading in and out of these things minute to minute. So, but that if the company does well and puts up good earnings results, that won't matter over the long term. So if you believe in the company, as it sounds like you do, I would suggest ignoring the short-term trading noise and the day-to-day noise, and probably even ignoring what the sell-side analysts are saying, and just focus on where the company is going to be 3 or 5 years from now, and that'll probably do well. We don't, as I said, don't own Manulife. We do own another insurance company in the P&C space, Fairfax Financial, which is a really successful Canadian insurance business as well that we quite like. And I find the property and casualty companies maybe a little bit easier to understand than the life insurance businesses, where there's a lot of sort of investment risk and very rate sensitive, whereas the P&C companies are a little more straightforward. So that's why we've sort of chosen to own Fairfax for our insurance exposure.
10 analysts say buy, 5 analysts say hold, 0 analysts say sell on shares of Manulife Financial. We will take a break. We'll be back with Colin Stewart of JC Clark right after this. He'll continue taking your questions on North American equities. Okay, let's go to our next caller and keep the questions coming to our guest, Colin Stewart. Chris is our next caller from Victoria. Chris, thank you very much for calling.
Oh, good morning, Paul, and good morning, Colin. Paul, great to see you back on. It's so nice seeing you and Andy rotate back onto Market Call every once in a while. I've been watching for 5 or so years. Yes. And my question today is on Target, Colin. It's down a good amount if you look at the 5-year chart. I didn't know this until recently, but it's a dividend, either aristocrat or king. It has, I think, 20-plus years of increases. And I'm wondering if you think this is a good time to step in for a 5-year hold. Thank you so much.
Yeah, Chris, I mean, I think Target is a really well-managed business, not one that we own on behalf of our clients today. We've certainly looked at it in the past. I think the company has struggled a bit, relative to some competitors like Walmart, where we've seen their stock hitting new highs recently. And the valuation multiple is certainly lower than some of the other retailers, but I wouldn't call it sort of outright cheap. But it is, you almost have to, I think, to buy a business like Target, you have to take a view on the U.S. consumer, and in our case, we're a little bit cautious. As I was talking with Paul earlier about, I just think there are headwinds. These tariff impacts are going to, affect a company like Target, where they bring a lot of goods in from overseas, and I mean, I'm sure they'll try to eat some of those and make their suppliers eat some of that cost. But ultimately, they're going to have to pass some of those costs on to the consumer, and that's going to make their products more expensive. So and potentially impact demand. So I think just retail in general, I think right now, and companies that import a lot of goods from overseas, they are going to be impacted by this tariff regime, which is still uncertain. So I would be a little bit cautious near term, but it is a high quality franchise. Okay, thanks for the call. Let's go to Mose in Vancouver. Hi, Mose.
Good morning, gentlemen. Thank you for taking my call. My question is on ATRL.
Atkins Realis, is that the big construction company?
Yeah, exactly. Yeah, and so we like Atkins. We have owned it. Just actually recently sold our position. It's had a really good run, and they for many years had problems. This is the old SNC Lavalin. They went through all kinds of turmoil with management and board and scandals, but the new CEO has done a very good job of cleaning things up. They recently sold their stake in the 407, got a very good price for that, and they really are, beyond just being a construction engineering company, they really are benefiting from some of the growth areas of the market, like nuclear infrastructure and building more, new nuclear facilities, and they've had a long sort of history in that that business. And we've obviously heard a lot of discussion around clean energy and nuclear being part of that build out. So they will benefit from that. And I think that's why we've seen the stock have a good run. It's not super expensive, but it's certainly not as cheap as it was. And that's, and I think some of the catalysts may be behind us with the sale of that 407 stake. So.
Company is a design, engineering, and project management company. I called it a construction company. It's really more of a design and engineering company. Let's go to Mike. He is in Toronto. Mike, thank you for your call. What's your question to Colin Stewart?
Hi, I'd like to ask about Dental Corp. It fell over 30%, kind of with overall markets in the fall and into the new year. Is this business really that vulnerable, or is it more of a steady business that you can rely on for the long term?
No, Mike, we own Dental Corp. We like it. I think it is a very steady business. I mean, it's a purely domestic Canadian business. They own hundreds of dental clinics. They're the largest owner of dental clinics in Canada. I think it's well run. They've been growing steadily, both organically and through acquisition. They've been one of the largest acquirers of dental clinics in Canada. And even though they are the biggest, I think they only have about 4 or 5% market share. So it's a very fragmented market, and they can go out and continue to acquire these clinics from dentists that are looking to retire or looking to put off some of the administrative work and just focus on the dental side. And with that scale, they have a lot of synergies on purchasing supplies and purchasing equipment, and they have a lot of technology for bringing in new customers and scheduling. So, there are synergies for a larger player versus someone who owns, 1 or 2 dental clinics. And it, doesn't trade at a demanding multiple. Went through a process a couple of years ago where there was they had looked at maybe selling the business or rumor that someone wanted to buy it, and nothing ever happened. But, I think if we look at the valuation multiples that dental clinics and consolidators of dental clinics in the U.S. trade at 13, 14, 15 times EBITDA, this company trades at about 9 times EBITDA. So at a big discount to the U.S. consolidators. So we think at some point it could be an acquisition target. Okay, thanks for the question on Dental Corp. Let's go to Gordon back in Victoria. Hi, Gordon. Thanks for your call.
Good morning. Acadian Timber, as part of a diversified portfolio, I like their hard assets. They own over 1 million acres of timberland in Maine and New Brunswick, and they've just recently started to sell carbon credits. What do you expect the impact of future carbon credit sales to be on cash flows moving forward?
Yeah, so I mean, we used to own Acadian Timber in our portfolios or funds years ago. We haven't recently, so I haven't kept up really closely with the day-to-day and quarter-to-quarter results. But I would certainly agree with you that it is a unique public company in Canada that gives investors an ability to own as really an infrastructure type asset that you're owning timberlands. They don't have sawmills like a Canfor or West Fraser would have. They're just a pure play on land, timberlands. They harvest that timber when it matures. They sell it to lumber companies, and I think for that reason it is a relatively uncorrelated asset and pays a dividend as well. And I think as many institutional investors and pension funds today would have a small percentage of their portfolio in timberlands as a sort of uncorrelated infrastructure type asset. So I think from that standpoint, it's sort of a unique and interesting part of a portfolio for a Canadian investor.
Thanks to Gordon in Victoria for that question. When we come back after this break, a look at Colin Stewart's past picks. Okay, it's time now for Past Picks here on Market Call, where we travel back in time to an earlier visit from our guest. We're going back to February of this year, February 19th, 2025. One of Colin's top picks on that day was Pollard Banknote, PBL, on the TSX, and that one is down over that period of time, down about 22%. What do you think today of Pollard, Colin?
Yeah, we still really like it. I don't think there's any sort of strong reason for it to be off as much as it is, but They're one of the leaders in the instant scratch lottery ticket business and have a big presence in this sort of new and emerging iLottery business. And it's one of our largest positions. We think the outlook is fantastic. It's a very cheap stock, and they've got a really long runway for growth in this iLottery space, where they're one of the dominant players globally, and more states are that sell lottery tickets are starting to do that online, and scratch tickets where you can actually play online. It's a little bit of a different demographic and customer, almost akin to somebody who would play a casino online or a slot machine or something. So and a lot of governments need money, and so the lottery business is a good steady long-term business, and they're one of the key players there. So we really like the outlook.
Okay, number 2 on that day was Information Services Corp. Recommended, as you can see, at about $27.50, now trading at about $32.50. That's a total return of 20%, Colin.
Yeah, we still own this company. We've owned it for a long time. It's a very steady business. I mean, their largest sort of business is they own the Saskatchewan Land Registry, and they basically make a fee from every single land or housing transaction that occurs in the province of Saskatchewan. They've got a 25-year plus contract for that, and it's basically an infrastructure type asset. Then they've got some other businesses that do technology and servicing for corporate clients, legal clients. They have a bunch of different businesses, but they're all sort of high barrier to entry, generate a lot of free cash flow, pays a nice dividend, and the stock has had a good run, and we think it's still pretty cheap, so we still own it. Okay,
and the third top pick on that day in February of this year, Brookfield Business Partners, BBU.U on the TSX. This one down about 2% over that period of time.
Yeah, we still like Brookfield Business Partners. It's basically the private equity arm of Brookfield that trades publicly. They own a diverse group of sort of technology and industrial companies. And, if you look at the value of that portfolio, they have a lot of private funds where pension funds come in and they put their money in those funds at net asset value and own it in much larger size than individual investors would by buying Brookfield Business Partners. But Brookfield Business Partners trades at a 30+% discount to that NAV. So you're able to basically purchase the same types of assets that big pension funds are at a 30% discount, and you've got Brookfield managing it. So we think it's a pretty good long-term way to participate in Brookfield's private equity arm, and they are also are buying back stock fairly aggressively, so which we like.
Okay, those are the top picks of Colin Stewart from about 6 months ago: Pollard Banknote, Information Services Corporation, and Brookfield Business Partners. We will be back with Colin Stewart. He's CEO of J.C. Clark. He'll resume taking your questions on North American equities. So give us a call or send us an email. Okay, let's keep the questions coming to Colin Stewart. Jacob in Toronto is up next. Hi, Jacob.
Hello, yes. Good afternoon, gentlemen. I just want to ask your guest about the Brookfield Renewable Partner. It doesn't seem to move anywhere. It's got a beautiful fundamental and good resources, but I think it's not moving. I don't have it. I'd just like to know if I can buy it or not. Thank you very much.
Yeah, Jacob, I would buy it. We own it. We like it and think it's undervalued and a really good, well-run company. They've got a diverse sort of portfolio of renewable power assets, a lot of hydropower, solar, wind, both in North America and Europe and really all around the world. They're one of the leading players globally, obviously run by and managed by Brookfield. And, we're seeing this huge increase in demand for electricity globally because of data centers and AI. And, it seems, at least thus far, that a lot of these big tech companies want to use renewable or clean power. They're striking deals in many cases with, renewable power companies to provide clean power to their data centers. Brookfield Renewable actually did a deal, maybe they announced 6 months ago, I think, with Microsoft to do a 10-year deal to supply power to some of their data centers. So, we just think the longer-term trend, despite the near-term underperformance, there have been some concerns around Trump's, big, beautiful bill and the impacts on renewable tax credits and things like that. But longer term, this is a very good business. There's a lot of growing demand for electricity, and I think clean electricity in particular that is generated from the types of assets that Brookfield has is going to do very well.
Okay. Thanks, Jacob, for your question on Brookfield. Let's go to Amy in Toronto. Hi, Amy.
Oh, hi, Colin. My question is a Northwest company, the grocery, the things in the north. I got in when it was down like probably 10%, but it seems like the stock is stalling or declining. Do you think it's a hold? I hang up and listen to your advice.
Okay. Sound quality wasn't there. It dropped out a bit, but we understand that the stock is Northwest, and she'd like your view.
Yeah, sure, Amy. We don't own Northwest, but I think it's a very well-run company. They've got a, I don't want to say a monopoly, but a near monopoly on sort of retail in Canada's north, and a lot of, there's been a lot of talk recently, obviously, with the new government in Canada of investing in the north, both from a defense standpoint to, protect our assets in the north, and I think, that's one of the things that could really, if we get more military bases and more infrastructure projects in the north, in a lot of provinces in Canada, I think that Northwest company could be, a real beneficiary of that. It pays a nice dividend, and it's been a, really steady long-term performer. So I would recommend holding on to that.
Okay. Thanks for that question. Dwayne is calling from Kelowna, BC. Hi, Dwayne.
Good morning. How are you?
Great.
Great. I've got a question with the Boyd Group Holdings. It's done very well over the last 20 years. It just seems to me that there's been a bit of a change in leadership with the group and a bit of kind of change in what they're doing. It seems like they're selling the stuff that was making them money, maybe. I'm just wondering, is it worth continuing to hold on to? I kind of have a lot of my eggs in that basket, and it's kind of looks to me like it's kind of hit its peak.
Yeah, Dwayne, I mean, we're familiar with Boyd. We don't own the stock, and you're correct that over the long term, it's been a very, very strong performer, but has run into some issues recently. I wouldn't necessarily attribute those all directly to Boyd. I think, this is the company that has auto collision repair centers, and they've been rolling those up. There are a lot of other companies that have been doing the same thing. They're controlled by private equity, and there have just been some headwinds in the industry. Obviously, during COVID, there weren't as many, collisions because people weren't driving. So these businesses had less to do. There's been some cost inflation on things like paint and labor, and I think the industry, the headwinds have been more industry specific. And I think it's a good company. It got pretty expensive when it was up over $300 there, but I think at today's price, the valuation is more reasonable. It's one that's on our radar screen. So if you have a huge overweight position, perhaps diversifying a bit and reducing the size of that would be a good idea. But I would hang on to some because I think it's a high-quality company.
He seems to indicate he has a large position. Do you have any comment on how much is too much for a single stock in a portfolio?
Yeah, we typically would think of something like 5% as being a reasonable level,
Mm-hmm.
Unless you had a really high conviction level or really unique insights on a business to sort of have 8 or 9 or 10% would be a fairly big position. So, and I'm not sure what he's talking about, but if someone has a 20 or 30% weight in a stock, one stock, I would definitely recommend reducing that to something more moderate, like a 4, 5, 6% weight.
Okay, thank you for your question on Boyd. Let's go to Matthew in Markham, Ontario.
Hey, good afternoon. Got a quick question for you about Google. A lot of outperforms, a lot of overweights on it for a company with only about 12% upside on it on average. What's holding it back? PEs are only 21. It seems cheap here. Where do you see it going in the long run?
Yeah, Matthew. So we like Google or Alphabet. It's the only one of the Mag 7 stocks that we actually own. It's by far, I would say, the cheapest of those. I mean, Meta was cheaper a few years ago, but it has had a huge run. And I think often the way we think about it just simplistically is if you have a really high quality business and it's sort of out of favor, it's down for near term, short term reasons. There've been obviously concern about AI and all these AI engines and ChatGPT and that taking Google's sort of core search business or impacting that. But there really hasn't been evidence of that yet. And Google's been investing in artificial intelligence for years. So you'd have to believe that they're going to be able to find ways to protect their franchise and benefit from that. And I mentioned a bit earlier, they've got this leading sort of autonomous vehicle business with Waymo that is much bigger than Tesla's robotaxi business. There's really no value on that right now. So I think not only is it a cheap stock, but you're getting sort of free optionality on things like a Waymo to the extent they were ever to spin that out or as a separate public company or something. And it's one of the great sort of business models that we've seen in the world really in the last 20, 25 years. So when you can buy it at, I think on a forward earnings basis, it's closer to 17 or 18 times. I think you can't go too far wrong.
Okay. Thanks for that question on Alphabet. We will take another break, and when we come back with Colin Stewart, he'll continue taking your questions on North American stocks. Okay, let's resume our questions to Colin Stewart. He's our guest on Market Call today. Zern is in Courtney. Zern, thank you very much for calling. What's your question to Colin?
Thank you for taking my call. I'd like to get your take on Alimentation Couche-Tard. Seems to be out of favor because of that unresolved takeover bid for 7 & I.
Okay, Couche-Tard and 7 & I.
Yeah, Zern, I agree. I mean, I think Couche-Tard is sort of, not performed all that well recently. Investors aren't quite sure what to make of their, sort of persistent attempts to buy 7 & I or 7-Eleven, which is a Japanese domiciled company, and not yet clear, whether that's going to happen. It would be a very large acquisition. So I think perhaps investors are a little bit worried about, the amount of debt or they would have to take on or potential equity raises, but not yet clear whether that's going to happen. So, I think stay tuned, I guess, but it is, again, a pretty high quality company, one of the largest owners of convenience stores globally, and probably a good time to be looking at it because the valuation has contracted a bit here, and depending on what happens with that takeover, there could be an opportunity, and it's one we're looking at.
Okay, thanks for the call on Couche-Tard. Let's go to Paresh in Calgary. Hi, Paresh.
Good morning. Thanks for taking my call. My question is on Intel, INTEL. I guess I'm a little bit frustrated with that stock. I've been holding it for about a year, and it's not growing. In fact, it's 10% down. My question to you is, should I really hang on to it what's the future of this company, or are you guys holding a position? And should I hang on, or should I consider something else? Thank you.
Yeah, I mean, I think I'd hang on at this point. The stock is, as you pointed out, not done overly well. I think, a multitude of reasons, management turnover, some concerns that they've fallen behind other chip companies like an NVIDIA, and they haven't really, they're not positioned to benefit from, this huge growth in artificial intelligence. But, if you look at the estimates, the earnings and EBITDA look like they're going to expected to grow nicely over the next few years. And, the valuation for a company, considering how well many of the other semiconductor companies have done, is really not that demanding. It's only about 10 times EBITDA on, I think, 2025 numbers, and that's quite cheap compared to a lot of the peers. So if you've owned it for this long, I would recommend hanging on and seeing if they can turn things around.
Okay, thanks, Parash. Let's go to the email inbox. Jean writes us as follows: what is your opinion on Visa? Should I hold or should I sell? Sounds like our viewer holds the stock right now.
Yeah, I mean, again, Visa is a great company. I would put it in the category of really high quality, but quite expensive. I mean, but it's hard to argue. If you go back, a decade, this has been an incredibly, well-performing company and a great stock. And more and more people are using credit cards and aren't using cash for transactions anymore. I mean, there are some concerns about Bitcoin and different cryptocurrencies and threats to their business from, people buying in different ways and different technologies. But at the end of the day, I mean, I think a lot of people still use their Visa card pretty regularly, and that's why it gets a, very premium multiple.
Okay, let's go to another email. Here comes an email from Can, I understand. Can writes as follows. Hello, Colin. What do you think of Labrador iron ore? Do you own it?
We don't today. We have owned it in the past, and I think it's a pretty high quality iron ore deposit, right here in Canada. So good jurisdiction. There's obviously, I guess, some concern around the steel business, and iron ore goes into producing steel, and with all the tariffs, I think that that has probably had some negative impacts on the business. But it's a very long-lived asset and pays a nice dividend. So with the current share price off, it's probably a good time to be looking at it.
Okay, let's take another look at Labrador iron ore. You can see ticker symbols LIF. It has declined. It has gained about 6% over 5 years, so it has been somewhat challenged over 5 years. Essentially, has traded sideways over the past 2 years. That's it for calls today, but don't go away just yet. Colin Stewart shares his top picks right after this break. Okay, time now for top picks when Colin Stewart outlines 3 stocks he likes right now. And the first one is Matter Corporation, ticker symbol MATR in Toronto. Colin?
Yeah, so this company has gone through a major transformation over the last few years. This was the old Shawcor, that it was really primarily a pipe coating business for the oil and gas sector. So pretty volatile business that was up and down with the whims of the oil prices. And new management came in a few years ago. They sold that pipe coating business, got a decent price for it, and they've been really reinvesting into some of their other businesses, which are really primarily 2 divisions. They have a connection technologies business that really does specialty wire and cable, and then a composite technologies business that builds underground tanks for gas stations, for example. These tanks also are increasingly going into data centers and to hold water underground by the data centers for cooling the data centers.
Right.
So they're really positioned to benefit from that. So it's really a company that's going to benefit from, infrastructure investment, electrification, build out of data centers. And I think, in many cases, there's a set of investors that still think of this as like an oil and gas company.
Right.
They still do have a business that does tubing, that has some products sold into oil and gas, but it's a much smaller part of their business than it used to be. So it really is like a diversified industrial company, but it still trades at 6 times EBITDA. They've spent a lot of capital building out new facilities, modern facilities with more capacity over the last few years in their 2 divisions, and they're now just filling that up with new business. So we think their margins are going to go up over time. They're also at the end of that capital spending cycle, so that's going to cause free cash flow to lift quite a bit. And we think with that free cash flow, they're going to pay down debt, buy back more shares. They've actually bought back about, I think, 14% of their outstanding shares since 2021-22. So we really like the management team, think they're doing the right things, and think you're at the sort of end of that transformation, but you really haven't seen all the benefits yet. And as they fill up those new manufacturing facilities, generate more free cash flow, pay down debt, we think there'll be a pretty good multiple expansion, and this should trade at a 9 or 10 times EBITDA, which would mean a lot of upside for the share price.
Okay, Matter Corporation is number 1. Colin has mentioned Fairfax Financial through the course of this program. Top pick number 2 is not Fairfax Financial, but it's a Fairfax-related company, Fairfax India, FIH.U on the TSX. This is based on Prem Watts' knowledge and attraction to the Indian market, correct?
Correct. Yeah, it's. I mean, Fairfax India is one of our highest conviction investment ideas. I mean, it's a great, sort of don't worry about day to day, quarter to quarter, but a great sort of stock we think to buy for the next decade. I mean, I think many people know about the story in India. 1.4 billion people, largest democracy on the planet, very young demographics, very fast-growing economy, and with Narendra Modi getting reelected, a lot of pro-business, pro-growth reforms happening and continuing to happen. So, basically Fairfax India owns a portfolio of companies in India, roughly $3.5 billion worth of different investments. There's about 5 public companies that they own that trade in India, and then they have about 8 private investments. And the largest, and we think the real crown jewel, is their ownership in the Bangalore airport in India, which is the 3rd largest airport in India. I was actually there in January and toured some of the companies and was actually at the airport. I mean, it's just a remarkable asset. This is a high quality global infrastructure asset that a pension fund would love to own. Mm-hmm. And if you look at what those trade at huge multiples of EBITDA. And this is sort of embedded in, hidden inside Fairfax India, let's say, and marked at a very conservative valuation. We think they're going to eventually spin that out as a separate public entity. They've been working on that, and that will happen at some point, we believe. That could be a real catalyst for the share price. And even beyond, we think the book being, mispriced, or the book value being too conservative because the assets are priced conservatively, the stock actually trades at a discount to book on the stock exchange. Right. So it's a great long-term way to participate in the Indian market, and you've got, really the investing acumen and backing of Fairfax with you.
Do they own the entire airport, or a controlling piece of it?
They own 74% of it, and then OMERS has a piece of it as well, and a couple of Indian sort of government, quasi-government entities that own the rest of it. So, great.
Number 3 on this day is Black Diamond, ticker symbol BDI on the TSX. Colin.
Yeah, so Black Diamond has 2 businesses. One is, which people have traditionally associated with Black Diamond, is sort of the workforce or the camp business that used to house all these people on these huge oil and gas projects and oil sands projects. And that they still have that business. It's a smaller piece of what they do today, but we think actually, they're with more infrastructure spending, maybe a new pipeline project in Canada, those assets might do better going forward. But I think the real attraction of this business is the modular space business, and that is really, they own portable spaces that they rent out. And think about something in a project where a highway is being built or a construction project, these sort of, roadside little portables with offices that are on all kinds of different projects, both municipal government projects, infrastructure projects, mining. They also have a lot of portables that they provide for the education sector or schools in North America. They rent these assets in Canada, US, and Australia. They actually have quite an interesting business as well. It's under the radar screen, trades at a low valuation multiple, only about 7 7 times EBITDA, very high insider ownership. We think, I think the insiders own about 25% of the company if you look at the management team and board. And, they're really benefiting from all this infrastructure spending we're seeing. And we think we'll continue to, even some of the defense spending you're seeing in the development of Canada's North, people think will benefit Black Diamond's business. We really like the management team, conservatively run, generates a lot of free cash flow. So, a lot of things to like, and it's not that, I'd say that well-known or well-followed a business here in Canada.
How important is inside ownership?
Yeah, I think that's a really important component. I mean, the same way that we think when we invest for our clients, we have our own money aligned with them and the same fund strategies. So we like to invest in companies where the management team is not just being granted options, but they actually have skin in the game. They own common shares. They're in the market buying stock in the, regular market purchases, open market purchases, and that's certainly been the case with Black Diamond, that there's a really high alignment of interest, and we like that. So.
Okay. Colin, as always, thank you so much for being here.
Thanks, Paul.
Colin Stewart was our guest on Market Call. Let's take a quick look at markets before we turn things over to trading day here on BNN Bloomberg. There's a look at the North American markets. It's a down picture. The NASDAQ has risen at least to break-even territory. It has been the relatively the strongest performer all day long and is now break-even. The other two, the S&P 500 and the S&P TSX Composite Index, are down by about 0.25 percentage point. Let's cycle through some stocks that are moving in Toronto. First Majestic Silver. Silver prices are soaring. Silver is now priced at more than $38 per ounce. First Majestic is up 6%. Pan American Silver, PAS, is up 3%. Here's Osisko Royalties. It's a precious metals royalties owner. That stock is up 3.5% as well. And we'll quickly take a look at one more stock, Strathcona Resources, in the news because of a takeover offer. That stock up about 6% so far today. Thanks for watching Market Call. We'll see you right here next week. In the meantime, trading day is coming up here on BNN Bloomberg.